Good afternoon, everyone, and thanks for coming back after lunch. When the ASA asked me to speak on profiting from demographics, I thought, gee, where do you start? Because there's just so many different opportunities out there to invest where you can play the demographic theme. But what I really wanted to do today is just touch on some of the demographics that this country is going through, but also then take you through some opportunities across the different parts of the market where you can potentially participate in that demographic theme. But at the end of the day, as you'll see from some of the charts towards the end, just because a company or a property group or a property trust is invested and exposed to the demographic theme doesn't mean that it's going to be a ball terror of an investment and that every company or every property that's exposed to these sectors are going to be winners, because at the end of the day it still gets down to what are the underlying fundamentals of that company or that particular property. In terms of the investment landscape and the way we look at it, there's a whole bunch of things that impact on our decision making. I didn't put an advertisement up there for Folkestone, but for those people who don't know who we are, we're an ASX listed property fund manager and developer. We have a range of different property funds depending on people's risk return appetites. We've got a listed childcare fund called Folkestone Education Trust. It's the largest owner of childcare centres. That's listed on the ASX. And then we've got a range of unlisted property funds depending on your risk return appetite. Income funds that focus on office building, shopping centres. We do development funds, and we've got a seniors living fund as well. And we also have a fund that trades listed REITs, real estate investment trust. So the environment that we operate in, when we're looking at things, obviously the economic environment is very important. The environmental part of our business has been very important. Everyone's concerned about greenhouse gas emissions coming from houses and office buildings and industrial properties, and most commercial property landlords now get their buildings rated for energy ratings and things like that. So the environmental part is a key part of it. But the three most interesting parts in terms of what we see going forward and having the biggest disruptions to companies and also the property world is the technology, demographic and social aspects. And really today I'm going to spend most of my time, because the topic is about demographics, talking about the demographic and social things that people need to be thinking about when they're investing. In terms of comparing the different generations, I think it's always good because you hear all these terms, millennials, what are they? And I often get asked, what is a millennial? So typical of millennial is someone born after 1980, and they are in their own right a very interesting breed of people. Most of you in this room will probably have grandchildren or know people that are millennials, and you know that they're becoming more tech savvy. They've got very different lifestyle and consumption patterns to what you would have had at a similar age. We've got the Generation X's, which I fall into, the baby boomers, and then this particular slide they call the 72 to 80-year-olds the silent group. And knowing my mother, who's just turned 80, she ain't silent. But anyway, that's the time frame that we look at when we're looking at the different demographics and the different groups in terms of what are they, how are they consuming, how are they thinking, and more importantly, how are they investing? What is their risk return appetite? What sort of investment opportunities are they looking for? Because it will change as they go through the different age stages. The demographic themes that really we all should be thinking about is clearly population growth, and that's very topical because Australia currently has one of the highest growth rates of any developed country in the world. And that is in part because at the moment we are running a very, very high immigration intake of some 300,000 plus people a year. But also, and you'll see on a slide in a moment, we actually have had a huge growth in the number of 24 to 36-year-olds over the last couple of decades. And so we're actually having a bit of a baby boom as well. So the number of children being born is quite large at the moment. Then obviously we've got the growing middle class, and that's open for debate and will be more as we come up to the election with the difference between Liberal and Labor and Bill Shorten with this inequality and almost a class warfare type approach to the next election. But we do have a growing middle class. How well they're doing, how they're thinking at the moment is clearly very topical, because they may, in terms of their salaries, you know, the average salary's going up. Most people have got a fairly large house now. A lot of people have got 2 cars. There's a lot of consumption going on. But with low wage growth in particular, that is distorting how people who traditionally would be considered middle class are actually spending money in the economy. Clearly the ageing population, that's going to have a huge impact on a whole range of factors, which I'll talk on in a moment. We're working longer. The people are working longer. I think that's quite important now. We are seeing a lot more older people wanting to stay in the workforce, and I think that's part of the reason why we're seeing a lot of growth in part-time work. Is they may not want to work 5 days a week, but they want to keep active, they want to keep their mind active, and they're cutting down to part-time work. Increasing female participation, that is clearly a trend of all the major Western countries, that women are being treated equally or almost equally in the workforce, and so they should, and that's having impacts in terms of, obviously a lot of families are having dual incomes now, so that changes their income coming through, but it also means that there's more expenses in terms of childcare and things like that. And then the last one, which is probably the demographics, people would spend more on those other 5. But as you'll see in a moment, the urbanisation that we're seeing, and obviously Kerr was talking about it from a China perspective in the previous session, but even in Australia, the way our cities are changing and the way people are living and where they're living is having a huge impact and is creating some interesting investment opportunities, which I'll touch on in a moment. So this graph here, we talk about the age structure. We've just gone and put up the last 3 censuses and looked at in each of the different cohorts for those people up the back, this is the 0 to 4s, 5 to 9s, 10 to 14s. And you can see there's been a consistent and quite a large jump in between the last census in 2011 and 2016. And that's that baby boom that I was talking about coming through, because we've also had a big jump in the 25 to 30, or almost 39-year-olds, and that's the key, obviously, age group where are creating families and having children. And at the same time, obviously, with the ageing population and longer life expectancies, we've seen a material jump in the 60 to 64 and 65 to 69 age groups. As a percentage, that's the largest increase over the last 3 censuses in this part of the graph. But as a total number of people, we still have the 25 to 29-year-olds and the 30 to 34-year-olds as our largest actual number of people. So that concept of, well, you know, the population's ageing, yes it is, but we should actually be very happy that we've actually still got good growth there and good growth there, because these people are going to be coming through the system. Yes, these people are getting older and staying around longer, but this is still a very productive bunch of people coming through the system in terms of contributing to the economic growth by being able to work and things like that. And the other thing that I think is really important, and it's one of the key issues that we think that our cities, other than having certain politicians that sort of dropped the ball, and Bob Carr, if you remember back in 2000 around the time of the Olympics, said Sydney's shut, we don't want any more people. And if we were doing a residential presentation, I can show you a graph that shows the housing approvals that fell between 2000 and 2009. That's one of the reasons why we've got an undersupply of housing in Sydney at the moment, is because in 2008, 9, we actually built less houses in Sydney than we did in 1973. And so that was in part because the mentality of both the Labor government and the early stages of the Liberal government when they came in was they didn't plan to have this many people in Sydney. And if you go back to the ABS data, in 1999, the ABS does forecasts, which a lot of people rely on, planners, business consultants looking at the future growth. In 1999, they forecast the population in 2016 in Australia would be that. It turned out to be that. In Sydney, they thought it was going to be that. It turned out to be that. And in Melbourne, they almost got it wrong by 1 million people. And when you're planning for infrastructure, it doesn't matter whether it's roads, it's schools, it's hospitals, you've got to be looking out 20 years because the time frame that it takes to put it through the system, build it, deliver it, all of those things take a long period of time. So our planners and governments the numbers that they have been using, and sure they would have updated them along the way a bit, but the principle was that the growth in the population and the number of people living in Sydney and Melbourne is much higher than what our planners had thought there was the case, and hence why we've got this huge backlog of infrastructure, and now they're rushing to spend massive amounts of infrastructure in Sydney and Melbourne to try and catch up. The other thing that's is really, sorry, I'll just go back to the pointer, is just the quantum of growth even in the last little while. Melbourne grew by 2.4%, over 100,000 people last year. Sydney grew by nearly 92,000 people. So just for that new growth, and the average household is 2.4 people per household, just think of how many houses we need to build just to accommodate new growth in population, let alone people moving out of homes because they're younger, they've been living with their families and it's time to move because they're forming a household. So again, whilst we've seen a big jump in supply in the last two years around Sydney and Melbourne, we've had this massive backlog of poor supply coming through. So that's why even with the supply that's coming on, there is still a shortage of both rental accommodation and owner-occupier accommodation in Sydney and Melbourne. And that's part of the reason why prices have gone up. The other thing that we've seen is the distribution. I talked about urbanisation very early on in that other slide about one factor that you need to think about. We need to be looking at where people are living, and we've seen this massive change in the way that people want to live. They're happy to live more and more now in high-rise. They're happy to live in middle and inner suburbs. So we're seeing massive gentrification of South Sydney and other parts around Leichhardt and some of those older suburbs where there's been a lot of industrial that's been converted to residential. We're seeing mixed-use development now where you've got residential with retail. You've got Westfield shopping centres now looking at putting residential on top of the shopping centres. So we're going to see a lot more of that. But the critical thing is when it comes to services, there is a massive shortage again of healthcare, schools, retirement, seniors living in those inner and middle ring suburbs. And the reason is, again, the planners weren't planning for that. They either thought the population was going out to the fringes, which it still is, but or people were moving to the sea change, going up to the up the coast. And looking at the people in this room, but you've got a lot of people who thought they may move out of Sydney but are staying because both their children are working and they need grandma or grandpa around to pick them up after school or school holidays, or Johnny's sick this today, ring the parents. And also I think a lot of older people are wanting to stay in the communities that they've been living in. And so now you're starting to see a lot more retirement and aged care facilities now needing to be built in these inner suburbs. Schools is a massive issue. Under the previous governments, you go to the eastern suburbs of Sydney, they shut Vaucluse High School, they shut Dover Heights High School. There's only one school that's non-private in the eastern suburbs, Rose Bay. That's got nearly 1,200 students. It's absolutely brimming. You've got inner city suburbs. There's a shortage of schools in that inner ring suburb out towards Canada Bay and back down from Sydney Olympic Park back around through Belmore, Canterbury. Again, because the population in those particular parts of the city have actually increased because we've got more density, but again, the school system didn't catch up with it. our childcare fund, the Focus on Education Trust, we're developing at the moment 35 childcare centres around Australia, and the majority of those are actually in inner and middle ring suburbs. People say, oh, but childcare, you've got to be out in the new estates. No. There's a lot of young people working closer to the city that want to be, that need childcare. So there's huge demand in these inner and middle ring suburbs for childcare. So that's just some of the changes in terms of the way our urban environment is operating that's impacting in terms of investment opportunities. Demographics and labour force participation, as I said, this is one to watch because we are seeing a lot more older people at this end participating in the workforce, but we've got to be also mindful as we shift over the next 20 years that the number of people working versus the number of people who aren't, that dependency ratio is going to change. In terms of the social infrastructure and employment growth, where are the jobs being created? Because again, that's another good signal for the types of investments that you should be looking at. And this is Australian Government Department of Employment forecast out to 2020. Looks at the number of jobs by number and the percentage growth. Health and social infrastructure and social assistance, the fastest growing, and also by number the largest growing of employment over the next 5 years. Professional, scientific and tech, second fastest and second highest growth. Accommodation and food services, the way that we're consuming, just got to see it, the amount of money being spent in cafes and outdoor living now rather than eating in the house is growing. Education and training, another big area, again, just because our population wants to be better educated, but also just the quantum of exporting of our education services to offshore groups, both providing education services in other countries and obviously having a lot of people coming to Australia wanting to be educated in Australia, particularly from Asia. And then you've got the government and IT. The rest of these dots are all other businesses that are typical businesses, and that's obviously manufacturing and the mining sector. But they're the key sectors that are driven by demographics, and look at the growth that we're seeing both in quantum and in the percent. Digital disruption, as I said, in that early chart we had technology there. I only put this up because it came from a Deloitte study recently, and again those sectors that are most impacted by demographics are also, according to Deloitte, going to be most impacted by technology. So education, health in particular, recruitment, agriculture, and we'll talk about food a bit later, but as I said, these sectors, whilst they're very attractive from a demographic theme, they're also most at risk from disruption as well. So you need to be thinking about what that means for your investing. Another graph just to put ageing and automation in place. This came from a McKinsey study not that long ago and had Australia in the middle in terms of our population change as well as our ability to adapt to automation. So we're sort of in the middle ranks there. Demographics and wealth. Again, what types of investments do people want as they're moving through their lifestyle? So obviously workers tend to borrow in the early stages to fund mortgages and things like that. Could be education and then moving on to the mortgage. And then they revert to being savers in their later years. And I guess that's an issue for investors in terms of chasing yield. There's a massive amount of money looking for yield at the moment. And in some ways I think that's distorting some of the pricing of assets. And we're certainly seeing it in the property sector, both commercial property and even residential. And residential is more of a capital play than a yield play, but certainly commercial property. And the list of property trusts like the GPTs, Westfields, Stocklands, etc., that chase for yield has pushed pricing to points where in some parts of the market now we'd be saying people are overpaying to get an income stream at the expense of potential capital loss down the track. And you've just got to be mindful that, yes, you might be getting a 6% distribution yield and it might be tax deferred by 80%, and that's great for your cash flow, but you put $1 in, what's your dollar going to be like in 4 or 5 years' time when you get it back from that particular investment? And people need to remember, yes, go looking for yield, but investing is all about total return. There is a capital component that you need to be very wary of. Just looking at lifestyle consumption changes, because again, how's that impacting the retailers that are listed? What sort of stocks do you need to be looking at? There, look at this, pharmaceutical, the growth in pharmaceutical and other products in that range, massive growth. People jumped on the Blackmores chain and watched the price go up, and everyone got really excited, and then it's come back, and part of that was obviously the China phenomenon, but they were still selling a huge amount of vitamins and wellness tablets in this country as well. But as this shows, that's the retail spend over the last 10 years. And we're spending less on, obviously, newspapers and books because of technology and disruption in that. But and then cafes, restaurants and takeaway. And you just got to see the amount of coffee shops that have popped up everywhere. Everyone drinks coffee now. Some of my staff go down 5 and 6 times a day to the cafe downstairs. And cafes have become, for office workers, meeting spaces. How many people now, when you walk past a cafe, are having business meetings in cafes? And it's very cheap rent. We don't have it many. We don't. We've cut back on the number of meeting rooms upstairs, which lay vacant for quite a bit of the day, where you're paying $500-600 a square metre, when you can send your staff downstairs and have a meeting, and you pay for their 2 coffees, $3.50 each or $4 each. That's $8 to rent the table for an hour. Think of it like that. So we'll just go through a couple of quick sectors, and then I'll finish up, because I know you probably have lots of questions. Childcare, a growing thing. People like it as an investment because of the attributes, obviously working population, increased demand for childcare. A lot of government funding, although it is changing, so they're focusing in on providing funding for those people at the lower end of the socioeconomic range, rather than funding high net worths to put their kids into childcare. The sector is getting much better. The standards of care are significantly greater. There's a quality control now, and it's actually, if you talk to most of the childcare operators, they call it early learning now. It's not just babysitting because of the programs they're doing. And that's flowing through to key, and there's a lot of studies done at the social and economic benefits of having children in childcare. And it's a very strong industry from an operator's perspective if they're doing it right. And I'll talk about that in a sec. From a property perspective, it's land rich. They sit on, you need fairly large pieces of dirt. One of the issues we're finding with our childcare now is we can't get the sites in those inner and middle rings, because you typically need a 2,000 square metre site, because you need the outdoor play area, and we're competing with residential developers. We're now building 2-storey childcare centres and actually having, in some places, the childcare outdoor areas on the top level, because you can't get the big enough sites, so you've got to go vertical. The other thing is you get very good long 15 years initial leases, triple net, which means the operator's responsible for repairs and maintenance, not the owner of the property. But, I say big but when I go back to, not all operators are doing well, and you've got to be very careful. I'm just, in all of these, for the rest of the presentation, when I'm talking about these sectors, I'm picking just a couple of listed stocks to show you what they've done, and then the equivalent of how you could get exposure to that sector through a listed property trust. So in this case for childcare, that's Think, which is a recent entrant. They're doing a very good job, and that's G8. And they've been a huge conglomerator of aggregator of childcare operators. They were the darlings of the market there for a while, and they've gone sideways. Think. I've put on the same axes, so this is indexed to show you if you had have invested in the underlying property. That is FET, which is our trust, and or the blue one's Arena, and ours is the orange FET. That's still returned nearly 25% over the last 5 years, year on year, both of those REITs. The only reason it doesn't look very good is Think's just had this massive run up in the last 18 months, and now the market's sort of woken up that maybe they were pushing the multiple too high on their growth strategy, and it's sort of drifted sideways. Seniors living, hugely topical at the moment because of the Four Corners Sydney Morning Herald expose. Our view, and we're in this sector, we've got a retirement village at Castle Cove, On the lower North Shore here, we've just done a deal with Chatswood Golf Club to build a retirement village adjacent to the golf club house and build a new golf club house for them. So we like the sector. There is no question that there has been some of the issues raised by Four Corners is true. Some operators have been aggressive in terms of their pricing models. They have been less than transparent in the way that they describe their pricing models to consumers. And this is one sector where there's going to be huge opportunities. Our penetration rate for seniors living in Australia is about 5.7 people over the age of 65 live in a retirement community. In New Zealand it's 7.5%, and in the US it's 12%. And one of the fundamental reasons for that low penetration rate, we think, is it has been a bit opaque in terms of understanding the structures. And a lot of the facilities are basic, just residential facilities. The new generation of seniors living communities has got to be about service. The real estate's important, the location is important, but it is a service offering. It's long-term hotelling. If you go and stay at a hotel where you get poor service, you're not going to go back there. But if you're decided to live in that community, you have to get good service because you could be there for 5, 10, 15 years. So the new generation of operators and the ones who are going to do well in this space are going to be focused very much on service, bringing home care into the village and having proper facilities. Our one at Watermark at Castle Cove, it's got a cinema with gold class seating in it. It's got a gym. It's got a bar. It's got a beautician salon, so the beautician can come in 3 days a week and work from there rather than people having to travel. It's got a room where a doctor can come in. He comes in 2 days a week and sees residents. It doesn't have a pool. The good one, we don't have enough room for a pool. A lot of the good ones now have pools as well because people are active. They want to do swimming, etc. There, it's like a hotel resort style facility as opposed to the older style retirement villages are just basically 2-storey walk-ups or single-storey villas, maybe with a little common area in the middle with a room where people can get together. Those ones are the ones where people are going in, have gone in 10 years ago and finding that when they're leaving, the resale value is not there because the new generation of baby boomers who are moving into retirement have a bigger expectation of the quality of the facility and the quality of the service, and a lot of those older style stock is just not acceptable. In the aged care space, it's exactly the same thing. Under the government's own numbers, we need 84,000 aged care beds between now and, or between 2015 and 2025 over that 10 years. Half of the existing stock in aged care should be demolished. The 4-bedded wards are just out. Even 2-bedded wards. Most people, if you're putting your spouse or your father or mother into an aged care facility, you want to put them in a single room because they've probably only got 18 months, 2 years to live. You want them to be, the last couple of years of their life, living there in dignity. The grandkids, when they come and see them, don't want to be in a room where there's other old people who are at various stages of either dementia or other things. So again, the quality of our aged care is changing dramatically, and there are some very good ones, and a lot of that older style stock is coming out. And what we're going to see, and I'm conscious of time, and I'll talk about it in a sec, is co-located facilities where we have aged care and retirement in the same community, because a husband and wife might go into that community, one gets frail or dementia, doesn't want to move out, they can move just up into the facility somewhere else and be in that same community and have access. So what you're seeing now is aged care, and it may not be the same operator, they could be co-located, but the aged care is operated by someone and the retirement seniors living community is operated by someone else, but from a resident's point of view, you're in the same community. And we're actually seeing again in those inner suburbs now, we're starting to look at vertical integrated facilities where Australian Unity's done one in Carlton in Melbourne and it's done a fantastic job. They've got aged care on the lower levels and they're putting retirement on the upper levels. Anyone that's been to see what Moran's done in Vaucluse, it's the absolute Taj Mahal of aged care and retirement, and it's very expensive, but it's in a very expensive area. But they've got integrated aged care and retirement in that one particular facility, and it's four levels high. So we're going to see more of that. We're going to see more consolidation. There's still highly fragmented markets, and you've seen that a little bit, and it hasn't worked particularly well. They were the darlings of the market when they first listed, Japara, Esty and Regis. They got hit last year because of changes in government regulation and the listed market's perception of what these were. I don't think they fully understand the pricing model. And it is difficult for aged care because in the old days a lot of people just paid bonds, and the way the operator worked was you got the bond from the person coming in, used that to build other facilities, and then when that person left and the estate had to be paid back, the new person coming in paid a bond and he paid that person back. Under the new rule changes, someone can come in now and either decide to pay a bond or a daily payment, and even if they decide on day one to pay a bond, they've got 21 days to change their mind. Now, if someone's paying a bond and you've got to pay it back as the operator, and the new person coming in is paying a daily payment, it creates a cash flow liquidity issue, and that's where some of these stocks got hit. Are they doing a good job in terms of care? I'm not going to comment on that. Some of those are doing a very good job, some probably less so. So again, the issue is there is a good demographic. Everyone thinks ageing, more people going into aged care, we need better aged care facilities. But in terms of if you had to have taken a punt here, you would have done well. Now you've come back a bit. My view is it'll go back up, but the market's still trying to understand longer term how the aged care sector works. In terms of the different listed property opportunities that you can get exposure to, Eureka, Avio did pretty well. Four Corners report comes out and the stock's been dumped, the Eureka got hit last year because they weren't growing their portfolio as quick as they said to the market. So again, be careful. You're still ahead, but not every company's operating exactly the same. Healthcare, I'll just finish up on two more sectors very quickly. Healthcare, clearly the expenditure continues to grow. This shows the number of hospitalisations by age group and gender. Us men, we think we're tough, but we seem to be going to the hospital a lot more than you women out there. But again, the ageing population is having impacts on terms of the type of healthcare that's required, the number of hospital stays, and that's creating issues for the private hospital operators because their model's based on getting people in and out pretty quickly, but older people take longer to recover, so that's having issues in terms of their turnover of patients and bed availability. But there's a whole bunch of issues. Technology advances, the way we're going to deliver health going forward through technology will impact as well on the sector. Here I've just put up a couple of the healthcare operators, Ramsay and the like, who own hospitals and primary healthcare. There was only one listed property trust that owned medical assets. That was Generation Healthcare. It just got taken private by a Canadian group a couple of months ago, so there's no way at the moment that you can get pure exposure to healthcare through the listed property trust market. I think over time you will see new companies come onto the listed market that will own the real estate assets and lease them to healthcare operators. Finally, food, another demographic trend, growing population, not just here in Australia, but China and Asia, a huge export market for us, and you can see there just the growth in the end value of the Australian food sector and the sales by the different market segments here. That's retail food, dining out, agriculture, but again, dining out having a huge impact. So again, what opportunities are there? Domino's Pizzas has been a big success story off the back of this dining out or getting takeaway. A couple of stocks I picked to get exposure to the listed food market, A2 Milk and Australian Agriculture Company. Again, massive difference in performance between the different types of companies, still exposed to that same theme of food and demographics. And there's only one real play on the listed property trust market, rural funds. Again, this axis has been distorted just by the sheer outperformance of A2 Milk. But rural funds, a year ago it was trading around $1 and it's at $2 now, so it's effectively doubled in just over 12 months, and it's been a standout. It owns vineyards, almond farms, it's got cattle farms, and it leases them back to operators. It doesn't actually do the agricultural operations. It's a pure own the land and lease it back.
What's it called?
Rural Funds. Very, very well run company. We've got a big stake in it in our REIT securities fund. So just to finish up, challenging time to providing money to work across all investment classes. Clearly the demographic theme, there's a lot of tailwinds there that makes this a very attractive opportunity. And I've just quickly given you an overview of a couple of key sectors that are a beneficiary of it. But the key thing is, as you saw on those graphs, not every company or every listed property group is benefiting to the same extent. Part of it is what segment of the market they're trying to serve, but the other extent goes back to what is the business model, what is the quality of management, what is the gearing levels, how are they managing their capital, how are they doing their marketing. All of those things that you'd look at in any other company that you were looking at, you still need to be careful. So my message to you today is there's absolutely an opportunity to play the demographic theme. There's no doubt there will be a lot of money made over the next 20, 25 years in this country from that theme, but you've just got to be very selective in terms of what you're looking to do, and understand that today's demographic win may not be tomorrow's demographic win as well. And I'll finish up there, Richard. Thank you.
Thanks very much, Adrian. Adrian is happy with questions. Can I ask you, please, if you're going to ask a question, just wait till Patricia brings around the microphone so we can all hear the question. So we'll open it up for questions.
Might it be suggested that one of our major problems in the world that we don't want to talk about is that we're overpopulating it, and that a lot of the things that we talk about would not be nearly such a risk if we had a lower population? Of course, we like higher populations because it means economic growth and more supermarkets, etc., but in the long run, are we really doing the world a service?
Good question. I would argue that in Australia we can take more people. The issue is that most immigrants who are coming into the country want to reside in Sydney and Melbourne. Most of the people who have been living here for a long time want to be residing in Sydney and Melbourne. And it is a real issue. If you go to the US, you know, they've got 50 states. The country's the same size as us. Sure, we've got a big chunk of our inner area of Australia that is you can't live in because it's desert. But the issue we've got is we've got Perth that was on fire during the mining boom and it has died. The economy over there is struggling. Businesses are struggling. The office space, the CBD of Perth at the moment, there's a 25% vacancy rate. If you're a business over there and you go and sign a lease for 10 years, they'll give you 5 years rent-free on a 10-year lease. So the issue we've got in Australia is I think we should be growing. The question is, how do we get people to move away from Sydney to other parts of the country? And we really haven't diversified and strengthened our employment basis, because at the end of the day, people move where there's jobs. And really, the issue is Adelaide. You know, for a young person, what are the job opportunities in Adelaide? Hobart, what are the job opportunities in Hobart? I think actually Tasmania is a good market to be looking at, because I think the tourism boom down there is just starting. But outside of tourism, there's not that many jobs. The young kids move from there up to Melbourne or Sydney for jobs. Brisbane, it's got a bit more of a diversified economy, but we really are focusing all of our engine employment growth in Sydney and Melbourne at the moment, and that's why people are coming to Sydney. And they're staying in Sydney despite the high house prices. And what they're doing is they're scrimping and scraping here and there, or they're borrowing off mum and dad because they want to stay here. So the issue for government in this country is how do we get employment and generate employment in other parts of the country, because that's what's needed. And I think that's the key dilemma that we as a society face in Australia. So you're absolutely right. The forecast for Sydney is that this will be an 8 million town in the next 20 to 30 years. You think of the congestion we've got, the public transport, the medical services, going back to my earlier observation about schools, all of that. Fortunately, we're finally starting to spend some money, and the New South Wales government's got a massive infrastructure program over the next 5 years, but it's a little too late. So that's the dilemma we face. And technology will help, I think. I think we're going to start to see technology helping, but unfortunately, at the other extreme, the old days of all the technology companies being out at Macquarie Park and in that campus environment, the new nickname for Martin Place is Silicon Place. You go down either side of Martin Place, it used to be all banking, financial services. Apple are there, LinkedIn are there, Dropbox is there, Atlassian, our largest tech companies there, all the major... So Tesla's got their shop front there in Martin Place. Why? Because all the young people who want to work for these technology companies want to live in the inner city, they want the cafe lifestyle, they want that, they don't want to be out in those suburban parks. GE has just moved their headquarters after, 50, 60 years to downtown Boston, because again, the talent that's coming into GE now wants to be in that urban environment. So at the moment, a lot of tech companies are coming in, but 20, 30 years, will we be able to work remotely? Will that allow people to not have to be in the city centres? Yes.
In some of those areas you're talking about...
Oh, sorry, I'll take that. You right?
In childcare and senior living and senior aged care and health care, there are a lot of not-for-profit operators, and they tend to pride themselves on being quality leaders. Does that make a difference when you're a commercial operator? How does it affect you?
We have had, in our childcare, we've had both not-for-profit and profit operators. There's no one to say, I don't think you can say the not-for-profit does it better than the for-profit. Each group has good companies or good not-for-profits and bad not-for-profits. So I don't think you can just say one's better than the other. You have to go in them. And there are some not-for-profits who do a fantastic job because they've got critical mass. Others have gone into that space because it's a bit of a sideline for what they really should be doing, and they don't have as good a management, they don't have the systems and processes like that. So, but it's the same on our childcare. We can look at a particular area and do all the demographics, and we've got operators who are making as good a margin out at Campbelltown and Western Sydney, where the average daily rate's $85 a day, as the person who's in a inner ring suburb where they might be charging $150 a day, because that person has, it's like McDonald's, they've just down to the nth degree worked out exactly how they provide their service. They resource it properly, they charge for it properly, but they don't provide any extra service. The inner ring ones have got higher land costs. They might provide extra services. I know some of our childcare operators are bringing in hearing specialists, dietitians. Some of them have actually got cooks where they're providing the lunch every day because the parents are too busy and don't send them with food, so they provide the food. So again, in that space, you've got to look at the individual operators, look at their business model, look at their systems and make a call. So I don't think there's one versus the other, and I think there's a real role for the not-for-profits. And Good Start, 59% of, or just under 60% of, about 55% of our portfolio of operators out of 400, they're very good because they cross-subsidise. So they actually operate, they've got a centre actually in Double Bay. that can charge huge fees, but they operate in other areas where a private operator couldn't make money because of the lower socioeconomic status of the area or whatever, or the way the parents pay. And they're cross-subsidising, so there's a real role for not-for-profit. But if you're going to be a not-for-profit in a lot of these areas, it's all about scale and systems and processes and quality of management, and that's, I think, at the end of the day, what the not-for-profits are doing. And it's the same in community housing now. We're seeing there's 330 community housing operators that are registered by the federal government. Only 40 of them are at a scale where you'd say that's a viable business. But they're all out there doing a meaningful job. But you're going to see consolidation in all of these sectors because you need mass and systems and processes.
Back.
Thanks for your talk. I've been reading that the government has been making noises about taking over the reverse mortgage space, because at the moment it's still quite punitive in a way. And they've also have started, and I gather they're going to really increase the carers going in and doing everything they can to keep oldies in the home. Take away from the growth of this business, or will it just attempt to keep up with demand as the baby boomers age?
It's going to keep up with the level of service. So what will happen is that the aged care will be still critical, because there'll come a time when even home care won't work for someone, and you do need to move them into an aged care facility where they can get 24-hour medical care. What it will mean is that we think the aged care component, you'll be in there for a shorter time period. So typically it's 18 months to 2.5 years, 3 years in some facilities. That will shorten, so there'll be a lot more turnover in those aged care facilities, but they're going to be critical because you just can't keep those sorts of people at home because of their palliative care, etc. In terms of the seniors living communities and the retirement village communities, it gets back to what I said earlier, service. So Watermark Castle Cove, we've got 58 apartments there, and we've got another 18 being built. So, and usually there's 1.5 people, because you've got some couples and some are only one person. So we've got about 70 there. We've just done a deal with a home care provider to provide services in there. Now, under the legislation changes, people can go and choose their own care rather than the government or the district provider saying, you must use this care. What we've done is, the benefit to our residents is, we've gone and screened a home care operator, because one of the things you're going to see in this industry, because as soon as government puts choice out, you get all these new groups starting going, right, we're in here, let's start a home care service, and the quality of the care is going to be quite varied. So what we've said to our residents is, we will go and look at all the different home care operators. You're still free to choose if you want to use someone else, but let us go and screen them. And the other thing is that we can then probably try and do a better deal by buying in bulk, because if they're getting some home care bought in, it's much more efficient. If that person's coming into the village that day, they can service 3 or 4 residents while they're there, rather than coming in and spending an hour with one of the residents, getting in the car, driving another 5 kilometres down the road to someone else, doing them, moving somewhere else. So we can actually create some economies of scale. We're providing a service to our residents, so therefore we would argue that the ambience and the reputation of our village is going to be much better than hopefully someone else's. So we're not as threatened. Yes, it might mean that people are staying there a bit longer instead of them leaving after the typical is 8.5 years in the inner areas. Some areas it's typically a 10-year stay in these communities. It might extend it a couple of years, but that's fine, because unlike some of the other groups and what the Four Corners program was doing, was saying all us operators in seniors living, it's all about churn. It's not, because the value of the property should be going up each year anyway. So if they stay a little bit longer, means the value of that property is going up, and the exit fee will be slightly higher, but the resident benefits because the property price should have gone up as well. So we don't feel threatened by it. It might have to adjust the model, the change of the pricing model a little bit, but our view is it's going to make those communities more enticing for older people to move into them. There is so many different pricing models, and this is the issue in the industry. And there are some operators who have got very aggressive models. And I'm not going to say which one we use, but at our Watermark one, we looked at one of our competitors recently, and there were, on a typical stay, there was about a $300,000 difference at the back end. So what and at the end of the day, the consumer will vote with their feet, and reputation in the community is massive. We've just done a survey up there, and every one of our residents loves being there because it's all about that service culture. And old people still interact in the community outside, whether it be the bowls club, the golf club, or whatever. They talk. So if you aren't providing a service or your contracts are too aggressive, that will impact in terms of your ability to get new people in. So we're part of the Retirement Village Association. Yesterday they announced an 8-point plan. We want national regulation in terms of this. We want accreditation of retirement villages because we and a lot of the other bigger operators aren't afraid of this. The more we can make those contracts simpler, the more transparent around those fees, the more attractive, and our penetration rates will go from 5.7, as I said, New Zealand it's 7.5, and in the US it's 12%. And that's the few, because the other thing we've got to do is free up, and it is an issue, these middle ring and inner ring suburbs. There's a lot of older people still living in very large houses by themselves, and that's a huge amount of supply that can be coming into younger people. So getting people out of these bigger homes, but not into something that they don't want to live in. As I said, you've got to create a community, you've got to have a service, and it's a good social benefit as well if we can free up some of these larger houses that where 2 and 3 bedrooms are unoccupied every night of the week.
Thank you, Adrian. We'll have to call it quits there. Thanks very much for your most interesting talk.
Thank you.
And Adrian, if I could just give you on behalf of the ASA, thank you.
Thanks, Richard. Okay, take care. Thank you.
Just a couple of quick notes, people. Don't forget the blue form, is feedback. I've got a couple of things I just need to ask you. Could you please bear with me? How many of you that are here